Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Here are the latest headlines on the Bloomberg. The fierce winds expected to continue in Southern California, exacerbating wildfires and putting lives at risk. And the number of dead that we know about right now, it is up to 24, and that's expected to climb. Let's get the update on all this. Will Wade is the Bloomberg Energy and Climate Reporter here at Bloomberg. Will, put things into perspective for those of us on the East Coast. How much has burned?
A lot. I mean, a whole lot. We're up to about 40,000 acres. I know that sounds like kind of a random number. So here's some perspective. 40,000 acres is a little bit bigger than Staten Island.
Wow.
What do we know so far about the origins of these fires? How it started and...
You know what? We don't know a whole lot about that. I was just talking to my teammates. We cover utilities, so obviously we've seen in the past a lot of power lines get blamed for fires, and so often it's the case. PG&E went bankrupt a few years ago because they started a terrible fire. Today, we don't know. The utility in Southern California Edison, and they are looking at the power lines. There's no evidence now, but they've fielded some of these requests to retain evidence, so that's definitely where people are checking first.
We've heard a lot of blame being pointed at the mayor, at the governor. Is there any legitimacy to any of that at all, as far as you can tell?
As far as I can tell, it seems like a lot of politicization. I may turn out to be wrong on that, but for today, I'd say don't pay too much attention to that stuff.
So you're the energy and climate reporter. For us folks out here in New York, help us kind of understand the climate in California, not only the geography, but just the winds and the weather that they have that kind of propelled this fire and is causing it to spread so quickly.
Sure. I mean, I know this really well. I grew up in California. The fall and winter months, the Santa Ana winds, they come every year. But what's happened in the past several years is, with climate change, we've got longer, hotter summers. We've had droughts. So you get these hillsides that are just baked dry all summer long, all fall long. There's nothing there but dry bush and trees, and it's fuel for fires. And then the winds come, and any tiny spark can trigger it, and the winds are going to just blow these blazes all over the place. That was the problem a week ago when there were like 90-mile-an-hour winds. They died down for a few days, but they started back up again now. It's supposed to last through Wednesday. Could be more after that. I think they're up to 70-mile-per-hour gusts coming this week. So it blows sparks, it fans the flames, it makes it harder to put them out.
What do we know in terms of the economic damage so far?
Oh, it's a big number. I just saw a number this morning. We're looking at $250 to $275 billion in damages. That's from damages, lost wages, supply chain disruption, sort of the whole package. But that's a lot of money.
That would place this at, correct me if I'm wrong, it would be in terms of the cost, the worst natural disaster in history, in U.S. history, I suspect.
It could be. I haven't seen a ranking on that, but certainly it's going to be up there. This is a big fire, and we're not done yet. I mean, the two main fires are the Palisades fire and the Eaton fire. Palisades is about 14% contained. Eaton is about 30-something% contained.
What does that mean? Like 14% contained. Does that mean that it's likely to just continue to keep spreading? Like, what is the definition of contained fire?
You know what? I don't know exactly what it means, but it certainly means that they are not even close to under control yet. They're probably going to get bigger.
That's the economic toll, the damages. There's also a psychological aspect of it. You know people out there. You're from that area.
I do.
What's going through their minds?
Well, I'll tell you about my aunt because I was texting with her yesterday. Her house is about 2.5 blocks from the front lines of the Eaton fire in North Pasadena. She evacuated a week ago, last Tuesday night. She was allowed to go home briefly to pick up some stuff over the weekend, but she is just really rattled. It looks like her house might be safe, at least from what I've been looking at today. It hasn't encroached on it anymore in the past several days, and I hope that stays true. But if she loses her house, it's going to be really serious for her.
And this is an area where it's just like you grow up, you live there, and then the landscape just like in a few days completely changes. That's got to have a tremendous impact on your psyche.
Oh, yeah. I mean, I know this area. I was there last summer. My mom texted me last week. She's like, remember that place we went for brunch last June when you were here? Yeah, it's gone.
Yeah. I've seen photos of some houses on blocks. They're the one house left standing, which in that sense, I guess you can feel lucky if that was your house. But then what happens? Then you move back into your house and all your neighbors are gone and then you're just on an empty block. I mean, that's devastating.
I would think that would really be hard to live there, just to look around at the community that you used to know and now it's gone. And it'll rebuild, but it'll be different.
What is your sense of what has to happen in terms of rebuilding and what happens in the future? I mean, can you really make your house and your property fireproof?
I mean, you can build it out of concrete, but the thing is, I've been writing about climate change for years, and it just gets worse. And more people talk about it now, but we still need to see behavioral changes. There are places that are no longer as safe as they used to be.
Well, I mean, behavioral changes in terms of what?
In terms of thinking, should I live here? Should I not live here? You know, there's a lot of coastal communities that are, you know, the local agencies are saying, we're not going to pay to keep rebuilding the roads when the oceans overturn it every summer. And you're going to have to think about how you want to live there.
Well, maybe, you know, we should all move to Vermont. Oh, but wait. Part of it was washed out because of the heavy rains. Maybe I should move to Florida, but I'm going to get hit with, you know, where do you go? What's safe now?
I wish I had a better answer for you. What I know is that climate change is real and it's a bigger threat than it ever was.
Do you get a lot of pushback when you say something like that?
Sometimes when I talk to my relatives in the South.
Yeah. Well, always a pleasure. Thanks. Will Wade, Bloomberg Energy and Climate Reporter on the Los Angeles wildfires.
You're listening to the Bloomberg Intelligence Podcast. Catch the program live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Tech-heavy NASDAQ down another 1% in today's trading. So what's next? Let's put that question to Kim Forrest, founder and CIO Bokeh Capital Partners. It's kind of safe to describe you as something of a tech geek, considering your background. What's on your bingo card right now?
Sure. Well, let's just make a mixed metaphor here. My bingo card, and I was a software engineer. I became a sell-side analyst that followed computer companies.
I didn't mean that as a
companies.
pejorative, but you know.
I know, no, nerd is like a good thing, man. I love it. Okay, but anyhow, just giving people background, and so I do look at tech, and tech, you know, it drove the market. Actually, one company really drove the market last year. I was looking at some statistics. Do you know that the S&P 500 is 15% NVIDIA? Holy cow, how'd that get to be there? Well, because NVIDIA grew, right? But is NVIDIA going to grow this year? Probably a little bit, but not like it did in 23 for sure, and maybe not as it did in 24. So, but should you throw out tech? I don't think so. I think there's a lot of smaller companies and probably companies that you don't think are in the bullseye of AI that you could take a look at. So that's what I'd do if you are a tech investor. But I'd also be very concerned about what's happening in bonds. And you don't expect a computer person or a software person to be concerned with that. But it really will affect the market if bond rates go higher from here.
Because the tech stocks in particular depend on future earnings, and yields are going to put an end to that party pretty quickly, I suppose. Yes.
I would love to be able to escape, math and math modeling, but it really does limit earnings whenever, rates go up. It is the thing that the 10-year is the number that everybody discounts forward cash flows at. So the higher that goes, the lower multiple that you can expect. Is it really that easy? Sadly, it is.
Okay, but, I'm just trying to think about years where, in the last maybe 2 years or so, there was a lot of talk about higher rates and how that was going to dent tech stocks. And it hasn't yet. I'm wondering if something has changed now that we're in what could be, I guess, good news for the economy means bad news for tech stocks because rates are higher. Because, we were kind of saying that last year and it didn't actually play out that way.
Right. And I agree with you 100% that things change. And we should never, ever just accept like those old sayings of Wall Street, because every year is different. We have different investors, we have different companies, we have a different rate environment. There's so much going on. So at the basis, I agree with you on that. I believe if you would have taken out the Magnificent Seven, which are all growing, well, mostly, we'll kick out Netflix and Apple, are mostly growing on AI, right? The theory that AI is going to drive these things higher in perpetuity. I think most of tech was down. And remember, tech spending used to equal business IT spending. So that's where the higher rates kind of come into play. It was businesses are not going to spend on IT and, because they're going to pull back and just not build for the future. So that's kind of one driver there. But I also think NVIDIA has had such an outweighed emphasis on the market, on tech and specifically for the last 2 years. If you go and look at their quarterly earnings and just look at the revenue, that tells you the entire reason why everybody has piled into NVIDIA and why it became, a less than $1 trillion company surely, and now the biggest company in the S&P 500, right? By market weighting and price. So it's been a completely outsized move because it had a completely outside move in its revenues.
Mm-hmm. Okay, so what's AI spending going to look like from here on out?
Right. Well, you get a kind of a picture looking at Microsoft. They say they said they're going to spend $80 billion this fiscal year. I think it was J.P. Morgan did a quick assessment on how much Meta, Google, Amazon, and Microsoft has spent. It looks like Microsoft was on track to spend about $80 billion last year because they did it from January to August. And I just annualized, whatever the run rate was. So that brings us to $80 billion. Now, let's not sneeze at $80 billion. That's a lot of money, but it's going from $78 billion in 2024 to $80 billion. So I don't know that the big spenders in AI are going to increase like they did in the last couple of years, again, because they could, right? They were spending zero on it, and now they're spending a lot on it. But I don't know that they're going to double it again.
Kim, always a pleasure. Thanks for being here. Appreciate it. Kim Forrest, founder, CIO of Bokeh Capital Partners.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Matt Miller here, sitting in for Alex. Emily Graffeo sitting in for Paul Sweeney on a day when the markets are down again. I looked this morning at the open. Emily, we were looking at 5782 on the S&P 500. You know what's interesting? That's exactly the closing level on November 5th.
Really?
Yes, the day of the U.S. election. After that, of course, we rallied higher. I think we were in the 5,900s already by the open of November 6th, but we've erased all of those gains and then some since we knew that Donald Trump won the presidential election on November 5th. We were also at 425 on the 10-year yield back on November 5th, and now we're looking at 477. So 479.64 right now on the 10-year yield. So we're up a solid 65 points from or 55 points from there. The Bloomberg Dollar Index also much higher right now at 13,022. We were at closer to 1220 back on November 5th. So we've seen all the wrong assets rise in terms of, I guess, bond yields and the dollar, and the right ones fall in terms of the stocks. I want to bring in Guarav Mallik to talk a little bit about this. Chief Investment Officer over at Pallas Capital Advisors. Does this repricing make sense to you, Guarav?
I wouldn't say that it makes sense. I mean, it's hard to make much sense of the markets these days with a lot being driven by sentiment. I think if you look at fundamentals from our standpoint from November 5th till now, in terms of actually what has occurred, nothing much has changed. I think we still expect that we're going to see a pretty solid Q4 earnings season. We remain excited about earnings for 2025. I think the places where most investors are taking a pause is really what's the action the incoming Trump administration is going to take on the policy front. So in some areas, I would say, yeah, a bit of a surprise to see the up rally and then the downtrend in markets. But from a fundamental standpoint, I think for stocks and earnings, we haven't seen much change.
So even after Friday's jobs report and the moves that we've seen in Treasury rates, you're still optimistic, then it sounds like, on the outlook for stocks for 2025.
We are. I think that, as we look at the fundamental drivers, which from a macro level, we think about what's going to occur with GDP growth, I think that looks pretty solid. When we think about companies' own projections, and again, as we get through Q4 season, we'll get a sense of how they're revising as we look at 2025. But again, expectation of about 5 to 6% revenue growth. Margins for the S&P are at all-time highs, which justifies, frankly, the multiple we're seeing at 21. So many things I would say that don't worry us too much. I think, yes, on inflation and yields, a bit more surprised on that front since November. I mean, again, but the market has been so volatile with incoming macro data that, in the morning I was talking with our investment team. We were talking about what's our projection for the end of the year. And I said, I'm just nervous about making a projection because the economic data that's been coming in and bond volatility, frankly, has been so high.
What about if we were to get, I'm not making a prediction here, but a Fed hike? Because when you look at 2-year yields, that is certainly what some bond investors are expecting to come. Do we need a cut for your kind of optimistic view to continue to play out? Or if we were to get a hike, could we still see stocks staying resilient?
So hike seems something that would shock markets, frankly, right? So now we're talking about a slightly different way to view that situation that would indicate to us that the Fed doesn't know what they're doing. Right. So far, they've been guiding us towards this fact that, OK, we think inflation is going to be under control. Now, again, that's been pushed off a little bit. Perhaps they were expecting a 2% number would have showed up by 2025. And I think that's looking more like 2026 expectations. But directionally is indicating that they're still in a mode where monetary policy is tight and they're going to keep it at that level. So a change in direction on that side to say we're going to certainly start doing hikes to tighten it even more, I think that would send a signal to the marketplace that the Fed doesn't know what it's doing. And then you're looking certainly at a spiraling effect on stock markets. So I think that would be very concerning. So, I mean, we get a couple of data points over the next couple of days that are going to mean a lot to the Federal Reserve. At least they'll mean a lot to how markets forecast what the Fed's going to do. We get PPI tomorrow, and we're looking for 3.8% on the core year over year. That's pretty high, right? And then we get CPI on Wednesday, and there we're still looking for 3.3% on the core number year over year. The Fed wants these numbers to be 2%, so they're still pretty far away. Don't rates need to be restrictive? Rates do need to be restricted, but again, when you think about the lagged effect of policy changes, both on the up and the down, still maintaining rates at a 4.25, 4.5 handle for the Fed is still tight. So maybe there isn't room for one more rate cut, which clearly the market is also pricing in at most one rate cut now till the end of the year. I think that is still in restrictive territory. Now, the inflation picture is also sort of clouded by the fact that there's a huge difference between what's occurring on the services side and on the goods side. On the goods side, we're seeing disinflation. We're seeing disinflation occurring in most of the parts of the world on the good side, right? That's going to flow through to some extent, again, notwithstanding what's the path the Trump administration takes on tariffs. But again, that's an effect that is disinflationary. So the real question then leaves us with is what's going to occur on the services side. And I think at a 4.25, 4.5 level, policy is restrictive enough that we will see a lagged effect show through in inflation numbers. Now, again, not to say that we'll get to just reiterating the fact that not to say we'll get to a 2 handle in 2025. I think that's not in the cards, and we don't see that occurring. But I think it gives us some confidence to say that 2 is a number that's possible when you look out at the end of 2026.
All right, Guarav, thanks so much for joining us. Appreciate your insight. Guarav Mallik there is the Chief Investment Officer at Pallas Capital Advisors.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.